Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Welcome, everybody, to Vantage Point with True North Wealth Partners. It's Tuesday, June 22nd, 2021,
All right.
and officially our one-year anniversary.
Yay! I can't believe it. We're no longer in training wheels.
That's
so
right.
I think
we're somebody.
We're no longer crawling. We're finally walking. So this is good. So the year's gone fast. It's been fun, and yeah, it's good. How's it been? How was Father's Day?
Yeah, it was good. Yeah, we trying to remember. Yeah, we hung out. We took we were out of town last week, so that was nice.
Good.
So yeah, how about you?
Yeah, it was nice. Actually, took the girls, hit the pool. So good times. The girls always like that. So can't complain. Very fortunate. Spent time with mom and dad, and my brother came over. So
Yeah, good.
all good. Well, good. There's a lot to talk about. We today later on we'll have a special guest and our strategic partner Ken Roselette. So we'll end with that. But let's get into it. So with the COVID tracker, as you'll see, so basically the United States finally it's curled over, gotten a lot lower, and should continue to go lower. Brazil, India as well. So it's nice to see a big U-turn. And then with what you have there on
Yeah, numbers looking better and better, right? So it's like even with Ohio, only I think they're saying around 50% vaccinated, and some states are higher than that, and some are lower. But you know the numbers keep dropping, so that's good. That's what we want to see.
Oh yeah,
so hopefully goes away. And I don't think it doesn't seem like I know they're talking about the thing. Of course, I'm not a medical expert, but what I've read about the variants is that there's not as big of a concern. Doesn't seem to be for people, at least for people who've been vaccinated.
Mm-hmm.
So time will tell, I guess.
We're getting there. So just a couple data points we're going to hit on. Number one, second quarter GDP. So it's going to be strong, huge. So the GDP nowcast was 10.5% as of 6/15. So 10.5% is the print for the second quarter GDP growth rate. So it fluctuates, it moves around, but that's somewhere in that range is the latest there. We've heard all about inflation. The PCE inflation number. So with this chart, you'll see it's now this was run in April, but with the latest, we had a 5% print. So that was like a week and a half ago came out.
Yeah,
5% print. Yeah. So still, we do not anticipate the 70s type inflation, but the next 3 quarters are 4.89. This is according to Hedgeye, one of our risk partners that we use, strategic partners. So with that said, north of 4% for this quarter, then 3.99, and then high 3.8 something, and then the point is it's going to be above 3.5 for the foreseeable future for the next few quarters. So meaning instead of 1.5, 1.75 average inflation for the past 10 years, sub 2%, we're going to be 3.5, 4%. So the upshide is inflation is here. We've all seen it. So how about the
get back to full employment?
Full employment, yeah. Let's talk about that. So full employment
that will help with inflation.
Yeah. So with wages, it's amazing. So there are companies, Wendy's, Bed Bath and Beyond, whomever. My friend's restaurant here in Dublin, Rick. So with him, they can't find employees. It's incredible. I was out doing client meetings. I stopped in at Bob's and they shut down. They closed at 4:00. I'm like, really? And it was, late, just a long day. And then I went to go have dinner there and no. So it's like, and I think you heard of something too.
We're on vacation down near Asheville, North Carolina. Yeah, we went out. There's some usual spots we go to and couldn't, they were closed. It was Monday, Tuesday, Wednesday, right in the prime of vacation, the Super Bowl, right, for restaurants in that area. So it was, and finally we got in. I think it was on Wednesday we got in, and I asked one of the waitresses, I figured what was going on, but she just confirmed that it was they can't find workers, so they can't work. They can only work half a week.
Good news is we're in the state of Ohio, so that extra $300 stimulus that they granted ends here this Saturday, June 26th. Yeah. So we're one of like 26 states, I believe.
Many other states.
That are stopping that. So that will help the overall release the wage inflation that's there. And as you have wage inflation, that does trickle down the end result user, because it all gets pretty much passed down to the end user. So, a lot going on there. What happened with Bitcoin and crypto stuff? I mean, man.
Yeah, what Bitcoin?
Yeah, thank you. So give us an update. You're the man, so let's hear it.
Yeah, well, if you've been following the podcast, well, I don't know, it's probably 4 months ago. I put $300 in, $100 in Bitcoin, 100 in Dogecoin, 100 in Ethereum. And at the height, it went up to 1,800.
Yep,
And
awesome.
and then I think as of yesterday, it was down to like $430 bucks. And so it's it's come way down. It's been volatile. I know Dogecoin's dropped 70% since Elon Musk
70%.
was on Saturday. It was on Saturday
Elon
night.
doing his little whatever.
Yeah, so you got that.
Pump and dump. Yep.
Yeah, it's crazy.
And Bitcoin, I think, a week or a half ago or so, in one day, tanked 30%. In one day, it down to 30,000. So that's
Yeah.
So it's volatile. It acts more like a commodity.
Yeah, it does.
More than a currency. So, natural gas used to be the highest and most volatile commodity. It's now been supplanted by all the Bitcoins and that type of stuff right now.
Yeah.
But
So what would happen if the dollar dropped 30% one day?
dude, watch out. That's why the SEC ruled against it last week.
That's right.
Remember the turtle versus the hare. We're going to wait till Federal Trade Commission, all the currency, the SEC, once it's regulated, because they want to own and control it, and not let the black market and others do that. So, again, it's good to be patient. It's good to own the infrastructure, meaning the
SRVR.
technology,
SRVR,
and another fund that we're using as well. But no question. So patience, and it will be there.
Yeah.
We had the job openings report hit a record 9.3 million. So that's the JOLT report that you hear about. So that's the most ever, decades. So again, plenty of jobs are out there. It's just they're not being filled. So hopefully that all changes. The supply, getting all the the moving of the what's that stuff called in the containers out in California, moving all that. So that's it will the pressure valve will be released. It's coming. Seeing corn and lumber, we've peaked. Net corn prices have gone back down. Lumber prices have dropped dramatically. Still well over 100% year over year, but not like the 300% plus. But there's still inflationary things around there. I will say this, and you've heard it.
The show goes on.
The show goes on, folks. We still have another round of of some good times ahead. So with second quarter earnings, there's a lot of volatility that occurred on Friday. It was for that week it was dragging on, but S&P down 1.9% for that week. As we get to the window dressing quarter end, and then also a month end, quarter end. A lot of window dressing going on. There'll be some more balances in the indexes, the Russell, things of that nature. So Friday might be another volatile day, things of that nature. But overall, GDP earnings, Alec, we're going to crush it. The companies are doing well, and we anticipate it. Like I said earlier on, more rebalancing will be coming up later in the summer, and rebalancing into the highs. So that's what we anticipate.
Yeah, and some as we go here sooner and later.
Correct.
But it'd be interesting. I wonder, with so much so much high expectations on the second quarter earnings.
A lot of it's built in.
Yeah. So if there's misses, then it could cause some volatility.
Yes. Right. So it's dog days of summer, but however, there will be spikes and the volatility of the VIX index that we've talked about, what the stock market anticipates over the next 30 days, that the traders think. Are on the print or a 14 handle. So right now, it spiked up to 20 last Friday. 8.17 now. It could hit a 14 handle, so lower volatility. But you can see those spikes well over 20 at any one particular day, just on whatever is out there moving the markets for the news of the day. We'll leave it at that.
Yeah.
Good. Well, all right. There's a little short one because we have a great strategic partner, Ken Rosalette. So. He and Robin, they've helped all of our clients. We've known them for Robin over 20 years, Ken over 5 years, but they've worked together well over 20 years together. So in-house tax planning and assistance. That's what we offer here at True North Wealth Partners, and hopefully you all enjoy what's coming up here with Ken.
This month's strategic partner, Ken Rosalette, is not affiliated with True North Wealth Partners or Stratus Wealth Advisors.
Welcome, everybody. So we have our guest specialist here today, Ken Rosalette,
Yes.
the preferred man. He's been doing this for 20 plus years. You're familiar with Robin Harriman. She actually spoke on one of our recent episodes in the past. But we wanted to bring in Ken today of his experience. He's an EA, an enrolled agent, and a CAA. It's a certifying acceptance agent as well. And with today, we have about 5 or so topics we'll address. The first one will be HSAs. We'll get into the child credit, dependent care, credit for sick leave, and then meals expenses, as we all like our meals. With that said, Ken, I appreciate you taking time out of your busy day. I know you have a lot going on and assisting folks with, key employees and setting businesses up, taxes, and all that stuff that you've done. So thank you for what you have done. But I'll turn it over to you. HSAs are big. So,
HSAs, I look at HSAs as being an overlooked deduction for a lot of people. You find that employers that offer HSAs, and of course you have to, if you aren't getting full health coverage, you're getting an HSA, and that's usually because you have a high deductible medical coverage. Right. So not everyone gets HSAs, but for those people that do, all too often what I see is someone will have an employer that will can put $2,000-$3,000 into an HSA, and they think this is great. They use it to pay their medical bills. But the thing is, they're overlooking that they can contribute more than what the employer has provided to them. And it has a long-term benefit. Eventually, it can be something that you can use as part of your retirement.
Yes.
It's treated very much like an IRA, and particularly if you are a married individual, you have family coverage. You can put anywhere from $7,100 to $80. Well, the new rate this year, $7,200, up to $8,200 if you're over age 55 into your HSA.
That's a lot.
And you can and you can keep banking that until you're age 65. And when you turn age 65 and you're on Medicare, and of course you can no longer contribute to an HSA at that point, you can use that money tax-free to pay for your medical expenses. Now, those medical expenses can include taking money out of your HSA to pay for your Medicare, for long-term care, and for any of the supplemental insurances that you may elect to use once you are retired. This is all tax-free.
Yeah, it's beautiful.
So you can build a huge balance. And again, it's like an IRA, that it's an investment. And it doesn't just sit there like in a savings account that we're paying very low interest. You can manage it just like any other investment. And so it's very beneficial. Again, too many people look at it, the employer gives it to me, that's all I can do with it, and really there's more. And when you retire, when you become 65, unlike years under 65, if you use that money for something other than health care, if you're under 65, what happens is you have to pay tax on it, and you have a penalty of 20%. Yep. If you're over 65, there is, and you decide you want to use it for something other than medical expenses, the only thing you do is pay tax. There's no penalty.
Ordinary income, right?
Yeah,
Yep.
yeah.
Awesome.
Ordinary income. So it's a great thing to have. Use it wisely. Use it, but it contribute as much as you can to it.
Right.
And also be careful with it during during all your years that you have it. Again, I see people that get HSAs and they give them a little debit card, and they can go into the grocery store, they can buy medical supplies, they can and use that, and they'll buy what I consider sundry supplies. They're nickel and dime things that you could take out of your own pocket, and you're basically, you wouldn't do that with your IRA.
Depleting it.
You wouldn't deplete it on minor
unnecessarily.
items.
Right.
Keep it for the big things. You know, you're supposed to have it if you have a big medical expense, but when you don't want to waste it, you know, because again, you have a retirement benefit out of it. So it's a
Beautiful.
great thing. Use it. Find out more about it if your employer has that for you, and see if you can go ahead and contribute more.
And to that point, to put a button on it, I mean, we offer it here for our company, a True North Wealth Partners.
Yeah.
So we contribute and participate, and it's great. The tax deferral, all the tax-free, you know, when you pull it out. So it's all awesome there.
Well, and you have to remember that the higher your income is, the more valuable this is because you're in a higher tax bracket. You know, it's one thing when you're in a 10% tax bracket. It's another when you get into the 30-plus tax bracket. So it's almost a bonus interest payment.
Excellent. Well, let's move on then to the child credit. So the child credit, that's a good thing, but there's a lot in the news lately, and just setting this up. So with the backdrop, the American Rescue Plan signed into law late March. So the CTC, child tax credit, there's a lot going on there. So in July, something becomes effective here in July. So it's good and bad. So we have to watch out with what they're trying to do. So with that, I'll let you go.
Yeah, well, with the child credit, there are a whole group of credits that have been put into place that are temporary, and they're going to be for just 2021. Now, does that mean that that's the way it'll stay? We don't know. They'll let us know when they let us know.
Right.
It seems to be the type of credit that it could be continued into future years.
That's their goal.
Yeah. How much can we give away? But the child credit we're looking at right now, they've made a number of changes. One, the basic credit in the past has been $2,000 for each child, up to the age of 17. Once you hit 17, you get no credit. You don't get the $2,000. But now we've increased that credit. Isn't it gone from $2,000 to either $3,000 if you're between the ages of 6 and 17, or $3,600 if you are 5 or younger, your children are. And that's for each child, for each child. So, it's a very substantial credit. And like I said, they changed the age of that you fall out of getting the dependent credit from the age 16 to the age 17.
One more year, right.
So you make sure you get that child on there. And what are we going to be doing? The government is going to start sending out checks to everyone and it's based on your 2020 tax return. If you didn't file a tax return, I think they're going to have a website that you can put your information in. But you'll start getting 50% of that credit starting in July, and you'll get an amount every month unless you opt out of it.
Right.
Now, why would somebody opt out of this? Well, this is not going to be a credit like they did with the stimulus, where no matter if you got too much, they let you keep it. This one is going to be clawed back if you receive too much when you file your 2021 tax return. So you have to be careful, because I have not seen anything where the government says how closely are they going to look at things like, are you income eligible for this credit? So you've got to be careful. And also, if you look at your 2020 return, a lot of people, you have movable children, particularly if you have divorced spouses that 1 year one person claims it, next year the other person claims it, and you have an issue where maybe one of the spouses claimed it in 2020, but won't be claiming that child in 2021. So they may get an advance payment, but they don't have that child on their tax return.
There'll be a surprise waiting for them.
Yeah, there will be, because they're going to. they've said very clearly that this is not going to be one they just let you hold on to. You're going to have to pay it back.
Yep.
And there are limits, and they've got a number of calculations in it. In that, there are two pieces. One, you have the 2,000 base credit that we always had. Then you have the additional 1,000 or 1,600, and anything above $150,000, you start peeling off the new credit, the 1,000 or the 1,600. So it doesn't take very long. I think if you're married filing joint, the credit, the max is 150, and you at 170, you've basically lost the credit.
Right.
So you want to be careful with it, but you can opt out of it. They're supposed to have a website. I haven't seen it yet.
Right.
And if it's a typical government website, even once you get to it, you may not be able to understand it. So just be careful. I've warned my clients to just set aside the money. If you get it and you don't really need it right now, put it aside because you may be paying it back.
Right.
So just be cautious. Don't have a big vacation on it,
Right.
and then have to pay it back later. And you're always going to have those people that don't want it because they like a big refund at the end of the year. You know, when they file their taxes,
They're used to it, and
yeah,
that's, it
they're
won't be
used to
there.
it, and this
Like,
could
what?
make it. This could make it even bigger for them. So it's going to be an interesting period to see how the government can manage this.
Yeah.
Okay, we're never quite sure.
And Ken, I'm old school, so it's called KISS. Keep it simple, stupid.
Yep, that's
so It's
right.
like, what ain't
Yep.
broke? Why mess with it? So it's
Yeah.
like, just do it normally, government.
Yeah.
You do your taxes next year, February, March, April. That's when you make the credits adjustments then, and then you move on. But this is just, I call it dog and pony show. So they like people to get hooked on the direct deposits for a reason. They have ulterior motives, and I'll leave it at that. But let's move on to dependent care.
Dependent care. Well, this is another one, all related. Dependent care benefits are being changed again for 2021. Okay. And the amount that you can claim as an expense has been basically increased substantially. Before, you could claim $3,000 for one child or $6,000 for two children, total expense. And that's the two children was the max that you could claim. You could never, that was at 6,000 was the limit. But now we have raised that to $8,000 for one child or $16,000 for two children. And part of the calculation is the percentage of that you get to put into your calculation. Before it was 35%. I don't want to get a lot of details, but it was raised to 50%. So the income's going to be greater that you can get from the dependent care. They also, in the past, the base amount that you got the most back from was at $15,000. Well, they've now raised that to $125,000.
Big increase. Wow.
A lot of people are going to be able to take advantage of dependent care that couldn't take advantage of it in the past.
Yeah. Well, that's
So
great.
that's going to be nice.
Yeah.
And of course, any of you, I'm well beyond the stage in my life where I have any children in care facilities, but given the even at $16,000 for two children, it's a miracle if you are only paying $16,000.
Right.
So it's a drop in the bucket.
Yep.
But the side part of this is that if you're a high income person and you are always losing out on the dependent care credit, and because of your income level, you could, through your company's FSA, and that's your flexible spending program, that you could put money into a dependent care account. And you had a limit up till this coming tax year 2021 of $5,000 that you could put in there. For 2021, you're allowed to put up to $10,500.
Beautiful.
So if you're a high income person that's never been able to benefit, you're going to get an additional $5,500 that you can take out of taxable income.
Pre-tax. That's the key.
Yeah.
Yep. That's a
And so
double.
if, if at $5,000, every $5,000, if you're in the 30% tax bracket, that's $1,500 in your pocket. So make sure that you talk to your human resources department, and if you haven't maxed it out, go ahead and make sure you max it out.
Yep,
I think
that's
it'd
great.
be beneficial.
All right. Well, that was very good information,
Yeah.
and definitely something that folks in the higher income
Yeah.
could use for sure. Let's move on to credit for sick leave.
Yes.
Sick leaves.
Again, we had this was in 2020 also, and it's all dealing with the pandemic. And in the past, if you weren't an employee of a large company, basically, if you were self-employed, the only time you took sick leave is when you weren't making any money. I mean, because if you weren't there to make it, it isn't going to happen. The government is allowing and will continue to allow self-employed individuals to take up to 10 days of sick leave. And it's going to be very beneficial. And there are going to be restrictions on it. It's basically for anyone that you had a family member that was affected by the coronavirus and you had to take care of them. There's a limited time period in which you can that this could have happened. It's between April of 2021 and September of 2021. But it's 10 days max, up to $200 a day unless you do a calculation based on your net income as a sole proprietor, and then you take 67% of that to come up and you get a daily amount. But you're allowed to be able to, for once, take sick leave.
Sick leave. That's $200 a day. So
$200 a day.
There you go.
Yeah, and I'm sure there's going to be, you're going to need to have support.
Oh, yeah, no question.
That this was for someone that you had to take care of and you had to be off work. But just remember that you do have an opportunity and I hope nobody was affected, listening to this was affected by the coronavirus, but if you were and you had to take care of them, then go ahead, or you were sick yourself. Make sure you take this as a tax benefit.
All right. And then last, let's talk about good old meals.
Yeah, the good old meals. I mean, this is one where a lot of us, particularly anyone that's self-employed, for as long as I can remember, meals have always been 50% deductible. And for this period, for 2021 and for 2022, you will be able to deduct 100% of your meal expense. Now, there are some caveats. The meals have to come from a restaurant. Either you've eaten them there or you've taken out food from a restaurant. Basically, you can't prepare it at home or you can't prepare it in your own cafeteria, but you can take up to 100% of the cost of a meal. Now, all the other requirements to be able to deduct meal expense are still in place. And that means it has to be for business purposes. You have to document who you took out and what the reason was that you took them out. And contrary to what a lot of people believe, if you're working in town and you're just going out to lunch by yourself, that is not a deductible meal. If you go out of town and you have to buy a meal out, that's deductible. Right. But you do need to have your documentation. But it's going to be and you can see why the government wants this. Yes. It's to help the restaurants out.
Yeah.
And I think it's one of the few things they've done. I think really is very beneficial. Yeah.
Well, and on the good note there.
Get back to normalcy here and
great.
help some people out.
Yeah. I appreciate it, Ken. We covered a lot today, everybody, so thanks for tuning in and listening to these great ideas. Appreciate having you and Robin both in-house. So that's what's nice about True North Wealth Partners. We have in-house counsel we can refer you to. They're great, and they've helped, dozens and dozens of our clients over the years, so that's awesome. And you enjoy the summertime. Have a great time in your upcoming trip.
Yep.
And
Thank you.
Folks, we'll touch again later. Thank you.
Okay.
Ken, take care.
Thank you.
Folks, thank you. I guess we'll wrap this up and stay well, enjoy summertime, and then we'll make some tweaks as necessary. We appreciate you and enjoy it.
Yep.
Life.
Stay safe. Thanks.
Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.